The head of Southeast Asia's biggest bank by assets says that AI valuations in the US are lofty, but there is value in Asia, particularly Japan. This as some US bank chiefs warn of a pullback in the equity markets of up to 20% as the benchmark S&P 500 continues to hit new highs. DBS Group CEO Tan Su Shan was speaking to CNA's Elizabeth Neo following the lender's earnings release today, where she noted that the markets have become more volatile these last 2 years.
I see a lot of, U.S. bank CEOs are saying, the AI is in a bubble. I think, leaders want to talk it down so that it doesn't go, too far up and then it crashes, because a crash is always more painful than a sort of a consolidation or a natural correction, if you will. I agree. I think AI valuations in the U.S. or, some other markets are very lofty. You've got real concentration in 7 stocks today. The U.S. market cap is 72 trillion. It's almost 3/4 of the world market valuation. Singapore, Hong Kong, China are trading at sort of the mid to low teens right now on the PE basis. So there is value, I think, in Asia, ex-Japan. Japan's also done incredibly well. So I won't be surprised to see a sort of asset reallocation, perhaps to this part of the world where yields are higher, dividend yields are higher. The currencies aren't too expensive, and the valuations are a little bit more reasonable.
And your personal assessment, that 10 to 20% drawdown, I mean, that number seems a bit scary, but do you have a number that
I don't know when you have stocks at $5 trillion. Yeah, I mean, you look at what happened to the price of gold, for example. They had a sharp uptick and then a recent correction. I think markets have become a lot more volatile in the last 2 years. Even interest rates and foreign and FX have become quite volatile. So equities, being volatile is no surprise. I think coupled with a lot of algorithmic trading by trading rooms, by hedge funds are dominating flows right now, and also by digital trading. Everyone's got a phone and you can trade, literally instant. So I think that exacerbates both the uptick and the downswings.
Now, DBS had reported a 2% drop on year in net profit for the 3 months ended September to 2.95 billion Singapore dollars, although the figure did beat market estimates. The bank said commercial book net interest income from its banking activities fell 6% to $3.56 billion, while overall earnings were supported by net fee income, which rose 22% to hit a record of 1.36 billion Singapore dollars. The lender said it expects 2026 net profit to dip slightly from this year as it continues to navigate the pressures of declining interest rates.
I'll interpret Q3 as a solid quarter. We had a lot of headwinds. The key was interest rates dropping. SORA, which is the Singapore Interbank rate, fell by quite a lot. So there was a big net interest margin headwind. Nonetheless, that was made up for by massive growth in both wealth management and deposit growth. So volumes made up for most of that headwind. And the wealth management and fee growth across all parts of the bank was very good. Trading income was also very good. So I would say it was a high quality quarter in spite of, the interest rate headwinds in Singapore, as well as the tax equalization. It's basically the minimum tax that we had to pay up by the full year will be about 400 million. We have a net floating asset book mostly in Sing. So if that drops, then we lose money on the interest rate. But we also have a floating liability, which again, and a lot of that's in US dollars. So if US dollar rates actually go down, we benefit from a lower cost of funding. So, but the net mix then depends on where rates go. So if US rates go down by more, we actually benefit. If Sing rates go down by more, then we lose. So this year, it's been one of Sing rates going down by a lot more than US dollar rates, and that's why we've been been impacted, and our NIMs have been impacted. But as I said, there are structural tailwinds that we are riding. One is wealth management. One is the revitalization of capital markets in Asia, and one is the rise of assets run by institutions, financial institutions, pensions, insurance companies, banks, non-banks. They're all growing really nicely. There's a silver population in Asia. They all need wealth solutions, and so insurance companies are growing very well here in Asia. So there's some structural tailwinds that we are riding right now, which should mitigate some of these headwinds around interest rates.